the U.S. Sovereign Wealth Fund in 2025, Foundations, Comparisons, and Global Lessons. Introduction. Hello and welcome to Future Finance Files, the podcast where we break down big, complex topics in economics and public policy, bringing you the stories that shape your world. I'm your host, your name. Today, we're diving deep into one of 2025's watershed moments in American economic policy, the creation of a United States Sovereign Wealth Fund, or SWF. We'll unravel how this new entity came to be, what it hopes to accomplish, and how its structure compares to global titans like the Alaska Permanent Fund, Abu Dhabi Investment Authority in the UAE, and Norway's world-famous government pension fund Global. But that's not all. We're also exploring how citizen benefit models, so-called dividends for all, fit into the story, and what the U.S. can learn from other nations both in terms of governance and in directly benefiting its citizens. Let's get started. Segment 1. The origins and vision of the U.S. Sovereign Wealth Fund. Let's set the stage. On February 3, 2025, President Donald J. Trump signed Executive Order 14196, setting in motion the creation of the first-ever United States Sovereign Wealth Fund. This was a remarkable policy turn, placing America firmly in the company of countries that have used such funds to steward national wealth, manage risks, invest for future generations, and, sometimes, deliver direct financial benefits to their people. The official policy, according to the order, is clear: maximize the stewardship of national wealth for the sole benefit of American citizens. The executive order highlights 4 specific goals. Promote fiscal sustainability. Lessen the tax burden on American families and small businesses. Establish economic security for future generations. And promote U.S. economic and strategic leadership internationally. On a practical level, the order directs the Secretary of the Treasury and the Secretary of Commerce, working with the President's economic advisors, to submit a comprehensive plan within 90 days. This plan must address funding mechanisms, investment strategies, the fund structure, and a robust governance model. Importantly, it must also consider the legal frameworks necessary for establishing and managing the fund, including recommendations for any required legislation. So let's pause for a second. Why the sudden move toward a sovereign wealth fund in the U.S.? Political context matters here. The U.S. has seen its federal asset base balloon, $5.7 trillion in direct holdings, not counting immense reserves of natural resources. At the same time, renewed interest in deploying these assets for strategic national projects and addressing fiscal stress has become bipartisan talking points. What's unique in the United States approach? According to statements from the Treasury and White House, the administration imagines the fund not just as a savings vault, but as an engine for targeted investments, critical infrastructure, technology, energy security, maybe even a stake in global digital platforms like TikTok or strategic reserves in Bitcoin and rare earth materials. But one of the thorniest questions right out of the gate: how will it be funded, and how will Americans benefit? Segment 2. The U.S. Fund Structure, Governance, Funding, Investment Strategy. Let's break down the early blueprints for the U.S. SWF structure, starting with governance. 2.1 Governance Framework. The executive order and subsequent advisory documents call for a governance model combining federal oversight with operational independence. Several options are on the table, including housing the fund within the U.S. International Development Finance Corporation, DFC. This would allow for interagency representation, including the Secretaries of State, Treasury, and Commerce, to ensure alignment across diplomatic, financial, and economic policy objectives. The DFC already has a built-out infrastructure for project evaluation, risk management, and cross-sector coordination, potentially allowing the Sovereign Wealth Fund to hit the ground running without building entirely from scratch. Independence is a critical concern. The most respected SWFs globally, think Norway's and Alaska's, are designed to minimize political interference, with investment decisions made by professionals rather than politicians. U.S. drafts suggest a governance board insulated from daily political shifts, with external audits, clear investment mandates, and regular reporting to Congress and the public. 2.2 Funding Mechanisms. Here's where things get interesting and controversial. Unlike countries whose SWFs are fueled by massive oil or trade surpluses, the U.S. runs persistent budget deficits. So where will the initial capital come from? The main funding ideas on the table include monetizing underutilized federal assets. This means selling or leasing government land, mineral rights, and used real estate, or federal buildings to create the fund's seed capital. Tariff revenues. The administration proposed using a portion of revenues from import tariffs to help seed the fund, though this is a politically divisive approach with uncertain revenue potential. Proceeds from strategic asset sales or sequestrations. For example, Bitcoin seized in federal operations or royalty revenues that would otherwise flow into general funds. But, as experts note, any move to capitalize the fund must navigate legal, political, and fiscal headwinds. There are calls to ensure seed funding doesn't come at the expense of essential public services or worsen the national debt. 2.3 Investment Strategy. The early vision for the U.S. SWF is a blend of savings fund, development fund, and strategic investment fund. Savings. Accumulate and preserve wealth for future generations. Reduce dependence on debt. Development. Invest in national priorities, advanced manufacturing, next-gen energy, critical infrastructure. A portion may be earmarked for high-risk, high-reward innovations that the private sector may be hesitant to fund alone. Strategic. Some industrial policy investments. Bitcoin reserves, critical minerals, even high-profile companies, are under discussion, modeled loosely on the strategic actions of funds in places like the UAE or Singapore. Should investments be kept purely international to prevent market distortions at home, or should the fund also be a player in domestic development? Early consensus leans toward keeping most investments offshore, following the Norway model, to avoid accusations of political favoritism and crowding out private capital. Transparency, public reporting, and annual audits are emphasized as must-haves to build trust and maintain fiscal discipline. For example, capping annual withdrawals from a fund at a set percentage of its value, as state-level funds in North Dakota and Alaska do. So, with the draft plans on the table, critics and supporters alike are asking, how will the fund avoid the pitfalls that have dogged similar efforts elsewhere? How can it be both shielded from politics and truly work for the American people? For answers, let's look beyond U.S. borders. Segment 3. Comparative Models. Alaska, Abu Dhabi, and Norway. To truly understand the pros and cons of the U.S. approach, we need to dive into 3 of the most influential sovereign wealth funds on the planet: the Alaska Permanent Fund, the Abu Dhabi Investment Authority, and Norway's Government Pension Fund Global. Each has a distinctive origin, governance style, and citizen benefit framework. Let's start with Alaska, the American pioneer. 3.1 Alaska Permanent Fund. Alaska's Permanent Fund is often called the People's Oil Check. It sprang from oil developments in the 1970s. Alaskans, wary of squandering their newfound resource wealth, amended their state constitution in 1976 to require that 25% of all oil royalties, later expanded, be locked away in a permanent savings fund. What's really innovative? The fund, managed by an independent Alaska Permanent Fund Corporation, APFC, is set up to operate at arm's length from political cycles. This independence is buttressed by detailed governance statutes, an expert board, and open annual reporting. And crucially, only the investment income, not the principal, can be used. Since 1982, every Alaskan who's lived in the state for 12 months receives an annual cash dividend, the famed Permanent Fund Dividend, PFD, ranging from about $1,000 to over $2,000 per year, depending on fund performance. In a good year, a family of 4 might pocket over $8,000. This direct citizen benefit model is rare globally, and it has become deeply embedded in Alaska's political and cultural life. The fund is also a model of transparency and public engagement. But there are challenges. Budget crises have driven politicians to tap excess earnings for government spending, igniting ongoing debates about the future of dividends versus public service funding. Alaska. Key structural elements. As you can see, Alaska's model is especially renowned for its citizen dividend, the People's Fund dimension that has been closely studied worldwide. 3.2 Abu Dhabi Investment Authority, ADIA. Let's travel to the Middle East. The Abu Dhabi Investment Authority, or ADIA, is one of the largest and most influential SWFs globally, managing over $1 trillion. It was created in 1976 to invest the Emirates oil surplus for the future welfare of Abu Dhabi. ADIA's governance is structured with a board of directors, a managing director, who chairs an investment committee, and supporting committees for audit and risk management. Crucially, while the board sets strategy, day-to-day asset allocation and investment decisions are delegated to professionals, supporting operational independence. ADIA is highly diversified, investing across equities, including passive and active strategies, real estate, fixed income, private equity, and alternatives in more than 24 asset classes worldwide. It manages portfolio risk with a substantial in-house team and a robust framework of internal and external oversight. Citizen benefits in ADIA's context are indirect. Fund profits support government spending on infrastructure, subsidies, and welfare in the UAE, but there is no direct dividend paid to individuals. While ADIA is often regarded as secretive by Western standards, it adopted the globally recognized Santiago Principles for SWF best practices and increasingly issues annual strategy and audit disclosures. ADIA, key structural elements. For the UAE, the SWF is a tool for diversification, helping ensure the state's prosperity long after the oil runs out, and supporting the Emirates' role in global capital markets. 3.3 Norway, Government Pension Fund Global, GPFG. And now, Norway, the gold standard of sovereign wealth funds. After discovering oil in the 1960s, Norway established the fund in 1990, with the first transfer in 1996. Today, it's the world's largest SWF, with reserves exceeding $1.5 trillion. Its mission, to transform finite petroleum wealth into lasting benefits for all Norwegians. Norway's fund is guided by strong legal and institutional checks. It is owned by all Norwegians, with management delegated from the Storting, Parliament, through the Ministry of Finance, to Norges Bank Investment Management, professional managers at the central bank. Investment strategy and risk benchmarks are set by law and refined via political consensus and expert input. The fund invests only abroad, primarily in equities, about 71%, with strict rules against taking controlling interest to avoid market distortion. Annual and quarterly disclosures, full transparency of holdings, voting records, and sustainability metrics are public. Norway regularly tops global rankings for SWF transparency. Citizen benefits are mainly indirect. The fund's returns fund government pensions, social services, as well as a notable share of the national budget. Norwegian citizens don't get a personal dividend check, but the fund's prudent disbursement, capped at about 3% of fund value per year, supports generous welfare programs and generational equity. Norway's fund is lauded for combining world best governance and transparency standards, a bird-in-hand rule, spending only the inflation-adjusted return, separation of political goals from fund management, robust ethical investing and environmental, social, and governance, ESG, policies. Norway, key structural elements. Segment 4. Comparative lessons. What makes a sovereign wealth fund succeed? So, when we put the U.S. plan side by side with these global models, what lessons stand out? 4.1 Best practices, governance, and funding. Let's start with governance. Independence. All leading SWFs build a strong firewall between political cycles and fund management. Alaska's APFC and Norway's GPFG stand out for their merit-based boards, transparent operations, and legal mandates that resist political overreach. Transparency and accountability. Regular external audits, public reporting, and thorough disclosures are now considered essential. The Santiago Principles, adopted by most major SWFs, set international standards for governance, investment procedures, and operational transparency. Public engagement. In Alaska, citizen attachment to the dividend program has forged a durable political constituency for fund integrity. Norway's Fund for the People, branding, open data, and annual public forums also reinforce trust. Funding source clarity. Funds seeded from non-recurring assets, oil, land, tariffs, must be ring-fenced and governed by explicit rules to avoid becoming piggy banks for regular politics or budget deficits. 4.2 Investment Strategy. Global diversification. Placing investments outside one's domestic economy reduces the risk of crowding out local business, political favoritism, or economic overheating. Both Norway and Abu Dhabi are notably global in orientation. Risk-adjusted return and long view. Funds must set clear benchmarks for risk and performance, resisting the temptation to chase fads or politically motivated investments. Norway, especially, is a model of focusing on the long-term real return, not short-term windfalls. 4.3 Citizen Benefit Mechanisms. Direct citizen dividends. Alaska's PFD is world famous, the only SWF routinely paying cash to citizens. Research shows this approach can reduce poverty and income inequality without reducing incentive to work. However, it also exposes the fund to competing claims when fiscal pressures rise. Indirect social benefit. Most SWFs, Norway, IDEA, favor using returns to fund broad social services and infrastructure, aiming for intergenerational equity, fiscal stability, and national resilience rather than individual payouts. Public support and legitimacy. Ultimately, the greatest sustainability comes when citizens broadly see the fund's purpose and rewards as legitimate, whether in dividends or in visible improvements in public goods and services. Segment 5. The Citizen Dividend Debate. Is there a case for universal benefits? This brings us to an area of lively exploration, citizen dividend initiatives, and a global debate around universal basic income, UBI, and social wealth funds. The idea, since national wealth, especially from common resources, belongs to all citizens, why not share the profits directly? This concept has roots stretching back to philosophers like Thomas Paine and recently gained momentum as automation and inequality spur calls for new forms of income distribution. Models include Alaska's PFD, the best real-world example, a universal and annual payment to every resident, funded by mineral and oil royalties. Universal basic dividend proposals. Some economists and advocates propose national-level versions, where the federal SWF distributes part of annual returns as solidarity dividends to citizens. Global experiments, from Brazil and Iran's national transfers to Swiss referendums and pilot programs in Finland and Kenya, there's a growing body of research about the employment and social effects, generally finding that unconditional dividends improve well-being, with little evidence of dramatic disincentives to work. The link to environmental management is particularly intriguing. Scholars propose that carbon taxes and polluter pays revenues be plowed into a sky trust, with dividends going straight to citizens, thereby simultaneously fighting climate change and lifting incomes. Yet, the flip side is practical. Many economists warn that scaling up these models to the federal level entails enormous fiscal, legal, and administrative hurdles. In the U.S. case, competing claims on the fund's returns, debt reduction, social spending, direct dividends, mean tough political choices. Segment 6. The U.S. fund going forward. Opportunities and cautions. So, what are the stakes as the United States embarks on this sovereign wealth experiment? Opportunities. Fiscal sustainability. If managed prudently, the SWF could help shore up public finances, smooth out economic shocks, and reduce dependence on debt and taxes. Strategic investment. Ability to take long-term bets on innovation, technology, and national security priorities that markets might neglect. Potential public buy-in, with openness to structured public benefit models, from universal infrastructure upgrades to direct dividends. The fund could rebuild public trust in the stewardship of national assets. Cautions. Governance risks. Without firewalls against political interference, there is a danger of mission creep or outright capture for partisan ends. Experiences from less successful SWFs show the cost of lax oversight. Asset monetization complexities. The process of selling or collateralizing federal assets involves legal, regulatory, and valuation hurdles that can stretch for years and may face popular and political resistance. Balancing competing claims. Would annual earnings be best spent on paying down the national debt, on public services, or on dividends? Setting clear, binding rules from the outset is key. Conclusion. The U.S. Sovereign Wealth Fund project is at a crossroads in 2025, full of promise, but matched by risk. If the United States can adapt the best global lessons, independence, transparency, public accountability, and public benefit, its SWF could become a pillar of prosperity and security for generations. But as we've seen from Alaska, Abu Dhabi, and Norway, building a truly world-class SWF is more than a technical challenge. It's a test of collective vision, trust, and political will. Will the U.S. fund be a game changer, or just another experiment in public finance? Only time will tell, but we'll be watching every step. Thanks for joining us on today's Future Finance Files. Make sure to subscribe for our next in-depth look at the economic policies shaping your world. I'll see you next time.